As you all know, Michael Burry, depicted in The Big Short by Christian Bale, made his millions by betting against the US housing market in the lead up to the 2008 global financial crisis. By buying credit default swaps on doomed mortgage-backed securities, Burry was able to profit over $100 million personally and made his investors around $700 million. He's known amongst the investing community as one of the great contrarians, with absolutely no fear to make big bets that fly in the face of conventional thinking. And now, with the release of his latest 13F filing, we can see he's made two such bets, one on the US regional banks that are currently under fire, and one in Chinese tech that's been crunched over the past 2 years. So in this video, let's have a look at Michael Burry's latest buys and sells and discuss exactly what his thinking might be behind these bets. So for those that don't know, a 13F filing is an SEC filing that all institutional investment managers with over $100 million in assets under management have to file at the end of each quarter. And what it does is it shows us their stock portfolios. So we, the public, get a glimpse inside the portfolios of the world's best investors. It's an incredible resource, but of course it comes with a catch. That catch being that we only get the info 45 days after the end of the quarter. But as you'll all notice, it's now mid-May, and thus the 13F filings for Q1 have just been released. So without further ado, here is everything Michael Burry did in Q1 2023. As you can see, he did a lot. He sold out of 5 stocks, including Black Knight and Curate, which we were discussing a few quarters back. Then he reduced 62% in Geo Group, the private prison company, which was his #1 stock for 3 consecutive quarters. He then bought 17 stocks, including names like First Republic and other regional banks. And then finally, he added heavily to his positions in JD.com and Alibaba, the Chinese tech giants. So there was a lot going on, but I'm sure you guys can already see 2 prominent themes emerging here: buying regional banks and buying Chinese tech. 2 very controversial topics. So let's start with the regional banks. Burry bought New York Community Bancorp, Capital One Financial, Western Alliance, PacWest Bancorp, First Republic, and Huntington Bank shares during the first quarter. Overall, these bets make up 24.26% of his portfolio, although now it's probably more like 22% as First Republic shareholders bit the dust. And I should also say that if you're interested in doing some research into any of these stocks that we discussed specifically in this video, I've actually made a Discover collection with Simply Wall Street discussing Burry's latest buys. So for example, if you're interested in, say, Capital One, you can go and check out valuation, future growth expectations, past performance, financial health, and so on, just by clicking the link down on my Discover collection in the description or in the pinned comment. And if you decide you're interested in signing up for Simply Wall Street, you can also get 40% off their premium subscription and a free 14-day trial. So that affiliate link is down in the description and in the pinned comment if you wanted to take advantage. But back onto Burry's bet on the regional banks. This is certainly an interesting move because, as we know, there are definitely problems at these community banks. And even if the Fed is ensuring all depositors will be safe, that certainly does not mean that shareholders will be saved. So what on earth is Burry doing here? Well, my best guess, and I should say I don't know 100%, but my best guess is he's making a diversified bet on regional banks as he feels the sell-off is overblown. I mean, basically all of these banks have been sold off anywhere between 30 and 90%. So I think he realizes he can't necessarily make a big bet on any one bank in particular, as who knows where the next bank run could happen, as it's all very psychological with depositors. But generally speaking, the risk reward on owning a basket of these stocks could be worth it in his eyes because the prices are just so low. This is kind of like what Warren Buffett has done in the past with the airline stocks and what he's doing right now with the Japanese trading companies. He can't necessarily pick a clear winner of the bunch, but he thinks the group as a whole will do well, so he makes a basket bet. And as I said, this is particularly prudent when you're talking about the regional banks because bank runs, which collapse these companies, are very psychological, and you can't simply predict which depositor base will run for the hills. You can kind of get a sense by looking at which banks are in worse shape or are taking big losses due to withdrawals. But when we're talking about bank runs, it is still very psychological and thus fairly unpredictable. It's very much a cascade of depositor behavior that could happen anywhere. So anyway, that's my theory, and I guess it does line up well with what he said on Twitter too. In mid-March, after the collapse of SVB, he tweeted that he expected the banking crisis to resolve very quickly and that he didn't see true danger here. Now, that mentality certainly lends itself to the theory that Burry is making a basket bet on heavily beaten down community banks, but I've also heard some people saying that Burry's bets on the community banks could in fact highlight the opposite thesis, that he's actually betting against the banks. For example, this article from CNBC said that the shares he bought could just be for covering short positions in the banks. Now, the way shorting works is that you firstly borrow someone else's shares and then sell them at the current market price, and then you hope that the shares fall so that you can buy them back cheaper, return them to the person you borrowed them from, and then you pocket the difference. Now, it's true that short positions don't show up in 13F filings, so this could be the case, but I'm just not sure if you'd have shares sitting on your books waiting to cover a short position. My understanding is that you choose to cover a short position and that whole transaction is just resolved immediately. I mean, personally, I don't short, so I don't know for sure. Hamish also highlighted that when you get up to this kind of level as an investor, oftentimes anything goes. You're playing more of a custom game with your broker than what we are down at ground level. But honestly, I just don't see it. To me, this thesis seems less likely, but I can't necessarily rule it out. So definitely let me know in the comments section if you have an opinion here. The other rationale I heard from people is that owning the stock could form part of some type of hedging for an option strategy where he's actually betting against the banks. But again, I don't think this works out either, as you do have to report put and call option positions alongside your equity portfolio each quarter. And this time around, there were no options bets from Michael Burry. So my conclusion anyway is that Burry is most likely doing the plain and simple approach of making a basket bet on the US regional banks and is hoping that while some may fail, overall the risk return is there as a group, considering most of these stocks are just so beaten down. So that was definitely the first really big bit of news from Michael Burry this quarter. But beyond that, we also have another big topic of discussion, and that is that Michael Burry is doubling down on Chinese tech. In Q1, he added 233% to his JD.com stake and doubled his Alibaba position. And these two stocks now occupy the top two spots in his stock portfolio. JD sits at 10.26%, and Alibaba is just slightly behind at 9.56%. Now, this is interesting because last quarter was the first time that we'd seen JD and Alibaba pop into his portfolio. So at the time, we were all just wondering if maybe this was a short-term play by Michael Burry. As we all know, he doesn't shy away from a short-term trade, and particularly because in Q4 last year, that was when we were seeing the relaxation of China's strict COVID policies. But at least for now, it does seem like he has grander visions for these positions by adding a lot more in Q1. He now has a $10 million position in Alibaba and an $11 million bet on JD. And again, I could be wrong, but I personally see this as a bit of a turnaround bet on two really solid Chinese businesses that have both seen their share prices destroyed over the past 2 years. It'll be interesting to see if these positions do truly turn into long-term bets though, as of course, I don't think these companies are going to get back to, record performance overnight. For example, on Tuesday, it was reported that China's consumer spending and industrial activity grew at a slower pace than expected in April, with many analysts predicting tougher conditions for the rest of the year. So things might take a little while to improve over in China. However, in both of these companies, we are starting to see glimmers of hope. I mean, in the last reported quarter, Alibaba did show improving revenue, gross profit, operating income, and net income. And while JD showed a seasonal reduction in revenue and gross profit in their most recent quarter, they did post improved operating income and net income, both quarter over quarter and year over year. So while China is still definitely sluggish, and there hasn't been too much of an overall lift in the stock prices so far, there does seem to be little glimmers of light at the end of the tunnel. So they were the big two bets by Michael Burry for Q1 of 2023, but I do just want to finish the video by highlighting one very important consideration that does seem to get forgotten about when looking at his portfolio, and that is cash. I mean, it's certainly easy to see the massive long list of buys and think that Michael Burry has just turned super bullish and he thinks the tough times are over because he's buying back in. But it's important to remember that if you look at his total portfolio size reported in the 13F, it's only 106 million. But if you look back a few quarters, we can see he had 165 million in the market at that time. And no, that doesn't mean he's lost 60 odd million dollars. He's of course held that out of the market. And chances are he probably has a lot more cash than the reported $165 million that he had in the market in Q1 of 2022. So long story short, Michael Burry isn't really going all in on the market again. He's actually sitting in a giant pile of cash waiting for more opportunities. So exactly what Warren Buffett is doing over at Berkshire Hathaway. So while these 13F filings are always cool to look at, we have to remember the big picture. Ultimately, they don't show us short positions, they don't show us international equities, and they don't show us cash positions. So we definitely need to put our critical thinking caps on when trying to make inferences from this kind of data. And when you do that with Michael Burry's 13F, all of a sudden it really starts to line up with the general sentiment he's been discussing over on his Twitter, that being that he's still a bit bearish on current market conditions. But with that said, guys, that will do us for this video. Definitely let me know your thoughts and opinions regarding Michael Burry's portfolio down in the comment section below. Also, if you've made it this far through the video, I'd really appreciate you hitting the subscribe button. We're trying to get to 1 million subscribers, so your help is very much appreciated. But apart from that, guys, please leave a like on the video if you did enjoy it. And with that said, I'll see you guys in the next one.